Street, you know, it's our November update. Time flies when you're having fun, Michael.
Yes,
P.
it does.
McCarthy.
Yes,
How
it
are
does.
you?
Doing good. Starting to
You
get
missed
chilly
me
up here.
there in Maryland?
Oh, it feels like you've never left.
What were you saying before I interrupted you rudely?
I said it's getting chilly up here, so I'm sure you're even happier down there now.
Actually, it's been cool here. I mean, it's not chilly, but it's getting down to like the low 50s at night now.
Yeah.
So, anyway, we're here on our November update, and markets are, holding up. They're up a good 20% right now, Mike.
Yeah. We've had a very, as we've been saying all year, very accommodative Federal Reserve. Every once in a while, they've decided to be more communicative, which is, maybe potentially spurred a little bit of volatility here or there. But 3-month Treasury is still at 0.06%. We have a very normal looking yield curve. And year to date, the S&P has been up 20%.
Yep.
Yeah.
But there's been a lot of rotation in stocks all at the same time throughout the year.
Yes. Interesting statistic is that 91% of the stocks that make up the members, they call them, that make up the S&P 500 have experienced a more than 10% decline at some point during the year. So we've seen volatility. We've seen a form of correction, but just not a very long-lived form of a correction.
Right. Well, it's funny. Through January through like July, the markets were up. Never got a call from a single client about any problems. In September, the market was down a little, maybe 5, 7, 6%, something like that. And people would say to me things like, well, my account's down. I can't believe my account's down $6,000. That's extremely volatile. And I'm like, no, that's the way markets have always worked. If you want to go up the 20%, you got to expect that you're going to go down 5, 10, 15% every so often. And sometimes they go down 30% and then recover and go up 100%, but that's the way markets have always worked.
Yeah.
You have to have volatility in order to make extraordinary rates of return.
Right. Yeah, you can't catch a falling knife is one of the sayings. Well, in those corrections we had during the year, about 18% of that was in energy. And energy is another major topic or another major contributor in another topic, which is inflation. It seems like every investor has on the tip of their tongue inflation. So CPI for the year is up 5.4%. But, a major driver of that has been in energy.
Energy. There are lots of things, but a lot of it has to do with just the overall disruption of the economy last year when you had the major lockdowns, and then COVID policies that are still ongoing in lots of places, and it's jammed up the supply chain, and but this has been going on, but slowly but surely, markets are figuring out how to deal with the supply chain. Personally, I'm not worried about inflation. I think I wrote an article about this, should come out next month, that the whole inflation story is more of a political story than it is an economic story. That's my opinion. We'll see.
Well, another thing that, Drew, you've made mention to a number of times in the past that I think this week I've seen a number of other people writing articles about it, is the effect that technology can have on inflation. And specifically, in the past couple of years, we passed a milestone where owning and operating electric vehicles is now less expensive than owning and operating gas vehicles. So the idea is that technology could drive costs down in certain areas enough to kind of bend the inflation curve.
Yeah, well, anybody who's worried about oil and gasoline prices going up, I mean, they are, and it's going to hurt for a little while, et cetera, et cetera. But you just think about everything that's happening in renewables right now in electric vehicles. And, I think gas companies and oil companies are basically going for the last nickel they can get before the price of gasoline and oil and the demand for that collapses. And so if you were Saudi Arabia or Russia, do you think you'd want to just be pumping out excess oil right now and trying? No, what you're trying to do is hold prices up as long as you can, so that when they collapse next, it'll be a long descent down, as opposed to just a complete collapse from who knows what. So inflation, sure, it's a issue right this minute. I don't expect 2022, 2023, definitely not 2024. We're not going to be talking about it again.
Yep. And with that, we've got a third member of our team joining us for the planning section of our update. Graham Ewing, welcome.
Thanks for having me.
He's not just any member of our team, Mikey.
Director of Financial Planning.
Yes, yes. Star of the company. Graham, good to have you. What are we talking about?
Thanks for having me. One of them. There's lots of them here.
So, Graham, there's a couple of things that are kind of sensitive that we're looking at towards the end of this year. Before the end of this year, we've got 2 months left to get anything done that's going to happen in the year 2021. What are some of those things we were talking about?
Yeah, there's kind of three things that really come to mind. So we'll start with the first one, and this really applies to estates that have more than $10 million. So if your net worth is over $10 million, there are some proposals in the law. I'm sorry, it's not law yet. It is still proposal. But things that make us think that you really need to start considering gifting. A lot of people are familiar with the annual gifting allowed of $15,000 per person. But what people don't realize is there's also this lifetime limit that you have available to you, which is much, much higher. And it's important that you talk to a professional to figure out what's right for you.
Yeah, we don't normally do too much around proposed law, but this year, a couple of these are making us think a little.
Right.
Well, we know that the law is going back down in 2026 anyway, Mike. So that's
Right.
why we're taking this seriously, because even if they don't advance it, it's going to come to hit us a few years down the road.
Unless your plan is to die in the next couple of years, which that's not a good plan. So yes, definitely want to
It could be a plan though, Graham.
What's that?
It could be a plan though.
It could be, but not the best.
Save tax dollars.
Right.
But Graham, what's
Right.
the most critical thing that our listeners need to consider before the end of the year?
Well, I think talking about these three things. So the second one is really Roth conversions. Specifically, if you have an account that has basis in it, you've made non-deductible contributions to an IRA, which is considered an after-tax money. And at the moment, people are able to convert that without really too many problems if that's the only money that's in the account. But starting next year, that could change. So this is proving to be important between now and the end of the year, even more than it has in prior years.
Right.
I've done a lot of Roth conversion calculations. I'm doing at least 2 or 3 a day.
Yeah.
And we just dealt with a client that they have, unfortunately, about $50,000 of basis, which is that after-tax portion, and then they have about $250,000 of pre-tax money in other IRAs, SEP IRA, and unfortunately, because there's that pre-tax money, we're not able to easily isolate that basis. But the problem is if this proposal goes into law, we really could be stuck with that in that account. And that's the thing we want to avoid.
Yeah, adds a lot of complications to it. And talking about the pre-tax versus post-tax, the deductible contributions versus non-deductible contributions. One of the things that became evident to me in the past month is kind of owning up to the fact that our advice over the last 10, 15 years has changed a little bit. So there are people that may have heard us talk about balancing between Roth and traditional 50-50, giving yourself different buckets. But, the things have changed. Graham, tell us a little bit more about that.
Yeah, I mean, it really has. I think that there's just more and more that's pointing to the direction of higher tax rates in the future, whether that's, next year or sometime, later in the decade, whether it's on the federal side or the state side, it's pretty easy to see that happening. So when we think about a Roth contribution or a traditional contribution, A lot of times in the past, we've said, well, let's do a little bit of both because we're not exactly sure. Let's hedge our bets. But now going forward, really the Roth contribution makes a lot more sense, with the caveat that it's still going to depend on your personal circumstances. One example being, are you going to move to another state in the future? Look at Drew, moved to Florida, no income tax. That's going to play a part here. So you want to factor in all of those things, but broadly, yes, Roth contributions are much more favorable than they have been in the past.
One of the few situations where we find ourselves playing a little bit more gaming into that is when we have clients whose adjusted gross incomes fall in some of the kind of cliff lines in the tax code, such as the Medicare tax. So it's always a unique decision to make, but it's certainly something that we are seeing more favor on the Roth. Another aspect of that is we have a software called Money Guide Pro that does basic calculations on, well, what's better over time. And almost any time where the beneficiaries are not going to immediately take all the money out and spend it, the Roth also generally wins out long-term mathematically.
Well, and that's a huge point, is what happens to these accounts after you pass away. And with the Secure Act that passed in 2019, most people now have to take that money out within 10 years. The beneficiaries have to take it out within 10 years, not equally over the course of 10 years, but at the end of it. So if you have that money in a Roth and you inherit it and it can grow for another 10 years tax-free, and then you take it all out, compare that to the tax bomb that could be created to a traditional IRA growing 10 years and taking it out all in that last year. Big, big difference.
So one thing that I can say is that there's a lot we just said that is complicated. And the good news is the clients know that we understand this.
Right. Right.
And we're hoping that they understood a good bit of what we were trying to say there, but it is complicated and it isn't an easy decision, because like Mike's talking about these cliff bombs in the tax law. Well, we could sit here all day and teach, and we wouldn't communicate 1/10 of all the information that there is. We're talking about the estate tax laws and all the things that could happen. We could sit here and talk till the end of the day, and we wouldn't even get an iota of the information that's necessary to make the right decision. But what we're trying to get across is these are big issues that cause lots of dollars in taxes if you don't have somebody thinking them out for you. That's really what we're getting to.
Right.
Right.
Like those non-deductible IRAs you were talking about, Graham, that $50,000, I bet anything, if you don't get that out of there, it's going to get double taxed in the future. Nobody's going to track it. Most people don't even know it exists in there.
That's true. And this client actually was pretty, it was on their radar. But the question is, in 30 years, when you have to still be tracking that.
And if it gets inherited by by a child or something, do they know that they have to continue to track it and so forth? Because it doesn't end. If it stays in there and the law changes, it does not end until the last dollar comes out of that account.
But you know what does end, Drew?
What's that? This video.
This video.
I knew you were going to say that, Mikey. You always ruin my fun. Anyway, we got to go. This is Drew Tignanelli saying God bless.